The Fed15 podcast is presented by Serving Those Who Serve, a financial planning practice serving federal government employees and retirees all over the country. This podcast is for informational purposes only and is not intended to be taken as financial advice. All listeners should consult their personal advisors before taking any action. The opinions expressed by our hosts are their own and do not reflect the views, policies, or position of either Raymond James or Serving Those Who Serve. Securities are offered through Raymond James Financial Services, Inc., member FINRA SIPC. Investment advisory services are offered through Raymond James Financial Services Advisors, Inc. Serving Those Who Serve is not a registered broker-dealer and is independent of Raymond James Financial Services, Inc.
Hello and welcome everyone to the Fed15 podcast presented by Serving Those Who Serve. Each week, we are here to discuss the latest news and info that feds need to know in 15 minutes-ish or less. A little bit different today because we've got a special episode for you. But whether you are a seasoned federal employee or whether you are just starting out in your career, Fed15 has got you covered. So grab your coffee. You might need a little extra for today's episode. We're diving in deep. Kick back and we will tell you what you need to know but might have missed. We are your hosts. I am Katelyn Murray. I'm joined by Dan Sipe himself, still in black, unfortunately, as of the recording of this episode. And we have a very special guest joining us today on the podcast.
We do indeed. We have the guru of all things FEHB. Okay, Kevin Moss, the senior editor of Consumer Checkbook's Guide to Federal Health Plans. And if you don't know about this, you have been living an incomplete life. Okay, because you're just making life harder for yourself. You know, it's like having a chainsaw and never starting it. Theoretically, you can still cut wood, but it's a lot harder. So, Kevin, welcome.
Thank you, Dan. Thanks, Katelyn. Appreciate the invite and always happy to be here.
Absolutely.
And sorry you're joining us while I'm in black, because as we touched briefly in pre-broadcast, whenever we're looking at a shutdown or in a shutdown, I put this on, and when they finally resolve it, I go into pink. So hopefully I'll be in pink. And yes, I know podcasts are supposed to exist outside of space and time. So we record these and then they go up later. So I'm always hoping somebody will go, senile old coot, the shutdown already ended. But Kevin, that actually, and we have a bunch of questions on behalf of our feds, that leads me to something right now, because, hopefully we're resolved by the beginning of open season. But what the heck happens if we're not?
Yeah, well, cross your fingers that we get out of this.
Come on, Katelyn, get those fingers up.
Yeah, get those fingers up. I won't call it good news. I think for most federal employees and annuitants, hopefully the government shutdown we're in right now will not impact them during open season. That's because most of the systems that federal employees and annuitants and OPM themselves, the folks who are running these systems, are essential, and therefore they are still working, even though they're not being paid right now, probably. But a lot of those systems are in place to handle your enrollment, or you're changing plans, or if you're changing your enrollment type. However, there could be some impact if you need, for example, to get some specific answers about your particular situation and you need to talk with someone at OPM about that. That may be a little bit difficult to try to get some one-on-one assistance with some of this stuff. Although OPM does man call centers, which are contracted out to, third-party vendors. They aren't necessarily federal employees that are answering them, but there's still a lot of OPM employees that are helping federal employees and annuitants on these one-on-one kind of edge case situations that are kind of falling outside of how the systems can help someone. So there could be some impact there, but I think hopefully for most people, you will be able to enroll, change health plans, and, change anything else that you need using your current systems that are already in place.
Got it.
Gotcha.
Yeah.
Gotcha.
Okay. That's helpful. Well, so we are going to kind of pick your brain today, Kevin, on all manner of topics related to kind of open enrollment. So a nice fun question to get us started, maybe. What are some of the biggest mistakes that you see feds make during open enrollment, and how can they avoid those mistakes? Tell us some horror stories from your side.
Well, okay, I've got a couple. I think the biggest mistake is doing nothing. That is obviously always the biggest mistake. And I can tell you a little bit about the implications of doing nothing this year. Let's suppose you're in FEHB, and for the last decade, you've been enrolled in NALC High. Doing nothing this year means that you're going to be auto-enrolled into a different plan. And why is that? Because NALC is leaving the FEHB program. They have two plans. They have a high plan and a consumer-driven health plan. Both those plans are leaving FEHB. This is going to impact about 29,000 federal employees and annuitants. And if you do nothing, OPM is going to auto-enroll you into GEHA Elevate, which may or may not be a good plan for you and your family. But I think most people want agency, want to be able to choose what the right plan is. So doing nothing, and, if your plan is leaving, means that you're going to be auto-enrolled into something that you know nothing about. And so beyond NALC leaving this year, there's a few HMOs around the country that are also leaving the FEHB program. So Aetna Open Access in Georgia, Arizona, and Pennsylvania. AvMed, they have a high deductible and a standard plan in Florida. They are leaving. The Blue Care Network of Michigan, the high version of that plan. Independent Health in New York, they have a high version that's leaving. Priority Health has a high standard and value plan in Michigan. Centara Health, a high deductible health plan and a high plan in Virginia. And so all those plans are leaving. If you're in one of those plans, your carrier has sent you by now a letter saying that, hey, your plan is no longer available. You now have, during open season, the chance to switch plans. The next mistake is not considering any new plans that may have, are new to the world for the next plan year. Not much next year. In fact, if you don't live in Fresno, California, or in Texas, there's nothing new. But if you live in Fresno, Kaiser Prosper is there in Fresno new this year. And in Texas, Baylor Scott & White has added value plans in two of their Texas market. Okay, the last piece, or the last big mistake, is what's happening with your plan's premium. This is a huge story every year. If you haven't heard the news yet, prepare yourself. It's 12.3%, the average enrollee increase, a share of the premium, 12.3%. So this is the second year of a double-digit premium increase. Last year, we were at 13.5. This year, we're at 12.3. This is back-to-back years of double-digit premium increases. And this is going to have a huge impact on your finances. Sometimes I feel like federal employees, because these premiums are taken pre-tax in payroll, it almost feels like funny money or monopoly money, because it's not necessarily directly coming out of your bank account, or you're not like kind of paying in cash. But these can really sneak up on you. And the cumulative impact of multiple years of high premium increases may have put your current FEHB plan as not the best value plan for you. And consider that the premium increase is just an average. There are plans next year where the premium is going down. In fact, 23 plans next year where the premium is actually decreasing. 57 plans are below that average. 49 plans are above that average. There is a plan. It will not impact very many people because it's only available in the Panama Canal Zone. This is a little insider fact.
Only you would know that. Only Kevin Moss knows this.
Okay. No, there might be a few other people, Dan, but okay. In Panama Canal, that their premium is going up over 100% next year. It's doubling. And, this is not going to impact very many people because you have to live or work in the Panama Canal Zone. But we still have some, federal employees who are down there. And, this could be really big. I think even if you think that you're happy in your plan, you do every year have to look at it. And, I could probably talk for another 15 minutes about some of the other things that I think people need to be doing every year, because premium is only one part of this puzzle. The other part of the puzzle is your benefits. I've just got through looking at every FEHB plan brochure, so you don't have to. But one trend that I have seen is it feels like about half the plans the catastrophic limit is increasing. So this is in the event that you have a worse cost year. In about half of all the FEHB plans, that catastrophic limit is increasing. And I've seen some plans that are changing almost all of their benefits, doubling the coinsurance from 10% to 20%, increasing the deductible, increasing their prescription drug costs. And, you might get hit by an increased premium, but you might get hit as hard or harder by what you're going to pay out of pocket. The best place to go to see how your plan is changing next year is the official FEHB plan brochure. These will be released on the OPM website. You'll also be able to find them on the carrier website. You go to Section 2 of the official FEHB plan brochure. Section 2 will say this is how your plan is changing for the upcoming plan year. All the meaningful, important benefits are there for you to see what's moving. And if it's moving in the wrong direction, you will want to then see what are some other plans that are out there where I might be able to get some better value. I may be able to lower my costs.
Very cool. Yeah, no, I think that is, kind of staying the same, sticking with that same plan year after year after year. I think a lot of feds don't realize that the landscape really does change from year to year, and certainly, over a period of years. So if anybody is listening to this podcast and you haven't really done kind of a comprehensive, look at what coverage is available to you, I think it would be a good idea to maybe, take a look, dig into some of those details, especially in the context of those rising premiums. So you touched on this a little bit in that last question, Kevin, but I think it might be worth taking a closer look at it. The rising premiums issue. So we get from our feds a lot, questions around how do I manage that? Like what are the concerns that I need to kind of weigh out when I'm looking at how much I'm paying for health insurance?
Yeah, well, you don't have a lot of choice if you want to stay in that plan because that premium is going to be leveled against you, right?
Right.
So we have to think about two things. Like in active federal employees, I feel like have more moves than annuitants. So let's talk about actives first. First is like if you love your plan and you've got the providers that you need and it's doing a good job for you, you'd rather keep it. Make sure that you're doing the other things to help save money next year. So one, every federal employee, everyone, 100% of all active federal employees should have a flexible spending account. If you don't, you're leaving money on the table. Okay. This is a no-brainer way to save money on your out-of-pocket healthcare costs. I think all of us are going to have out-of-pocket healthcare costs. Even if you're really, really healthy, you're probably going to the dentist once or twice a year. You may have vision expenses. There's even over-the-counter pharmacy items that are FSA eligible these days. One small bit of good news is that the FSA contribution limit has increased $100 for next year. You can put up to $3,400 into an FSA next year. And there is a little bit of risk of using the FSA. You don't want to put in the 3,000 if you think that you're only going to have 1,000 because you can only roll over. It's going up a little bit next year too, $20 to $680, but you wouldn't be able to roll over the whole amount. So you have to be you got to use a little bit of budgeting here to kind of figure out how much you think you're going to pay out of pocket. You have a little bit of wiggle room there with the rollover, but this is an easy way, to save money on your out-of-pocket healthcare costs. The FSA program, you go to fsafeds.gov. It has the same open enrollment or open season dates as FEHB. And so if you don't have that now, I really highly, highly suggest it. There is some administrative burden. Okay. You got to manage your receipts and stuff, but a lot of times now, the FSA program that the feds manage is paperless reimbursement. It's never been easier. A lot of this is happening even behind the scenes. Sometimes you don't even have to upload your receipts. So I think that for sure. And the reason I say everyone is if you're in an HMO or a PPO or a consumer-driven health plan, you can get the general healthcare flexible spending account. But if you are in a high-deductible health plan with an HSA, then you get the limited expense FSA for your dental and vision. And the reason you do this is because you want your HSA, if you can, invested, growing. And if we can use another pot of money that's tax advantaged to pay for our out-of-pocket dental and vision, then our HSA can stay invested in working for us behind the scenes, and we'll just use this limited expense FSA for our dental and vision.
Mm-hmm. Absolutely.
Kevin, did you get a copy of our questions in advance? I know you said you wanted to be surprised, but man, you are crushing these in order.
In order.
Okay. Katelyn, I think we had a leak. I think we had a leak.
Yeah, we had
either
to.
that or Kevin's just, we already know Kevin's a savant on this stuff. But I mean, in order.
We're going to have to talk to the podcast producers. I think somebody sent this man these questions. But anywho, no, he's just really that sharp. We are big fans of HSAs. If you are listening to this and you're not quite sure how an HSA works, to get the basics, if you'll go to stwserve.com, just put in the search bar HSA, you will find plenty of articles kind of walking through all of that with you. I'm a huge fan of HSAs. I have an HSA myself. I eat my own cooking. I fund that bad boy every year, and I try to leave the funds invested, kind of like Kevin was saying, let it grow. The big benefit there, just at a very high level, is you get to contribute to the HSA on a pre-tax basis.
Yep.
So those are pre-tax dollars that are going in. You can invest the funds. Normally, most plans make you keep about $1,000 in cash in the HSA. Anything over that can be invested for growth, and then it grows tax deferred, right? So there's no taxes as the funds are invested and growing. And then when you decide to pull the funds out of the HSA, whether that is before retirement or after, they are tax-free if you are spending on qualified healthcare expenses. And guess what you have a lot of in retirement?
I'm not retired, but I know.
Yes.
So
when your hair looks like this,
you have a lot
you
of
start
those.
seeing more.
All of that. And we also need to say something that non-medical is always on the table for you, non-medical distributions. Before you turn 65, there is a penalty for non-medical distributions. But once you turn 65, the penalty is gone. So I kind of almost think, I don't know what you all think, it's almost like a traditional IRA when you turn 65.
Except when you pull the money out, you don't.
For non-medical.
Yeah, exactly. Yeah. So I think they can. I've also heard them referred to. I don't know if this is actually a real thing. Maybe I heard it out of my own mouth, but like a healthcare Roth IRA too, because if you're spending that on healthcare, you're not paying taxes. So it's really fluid. It's great. There are some caveats for beneficiaries. So definitely hit the website to get it.
Miss Katelyn, no likey them being inherited.
Yeah. Not a great vehicle for estate planning, but excellent tool for financial planning.
Yeah. And I think, high-deductible health plans are underutilized by federal employees, and they tend to be the lowest cost health plan because there's something that's going on in FEHB that you may not find in other markets. And it's the fact that a portion of the premium comes into the HSA. This isn't your own money. So there's a premium pass-through that's coming into the FEHB health savings account. Now you can go on top of that. Okay. And by the way, the HSA is increasing too next year. The contributions a little bit. It's like $4,400, I think, self-only, up to $8,750 for family. So if your budget allows for it, you can go on top of what your plan is putting in. But your plan is putting in money into your HSA on a monthly basis in FEHB program. And unless, you have an employer like in the large employer space who's doing those contributions, most other folks are not getting that HSA contribution. They're just using their own funds to fund those HSA. So that's another big part of how FEHB plans with HSAs work that does make them low cost. The thing that you're not going to like it is before the deductible, you don't really know what something costs, right? There's so many FEHB plans where they offer fixed copays it's $30 to go see primary care. But when you're in a high deductible health plan, most of the benefits are framed generally as a coinsurance amount after deductible. So then you naturally think, well, what does something cost before the deductible? And the plan kind of is the shrug emoji, right? You don't know. We got nothing out there to help you. You can call the plan itself and you can ask them how much these pre-deductible expenses will be. And then the last thing is understand you're only making a decision for 1 year. You're not making a decision for the rest of your life.
That's huge.
The beauty of FEHB is that we're making decisions every year about which plan is the right plan for me. If you haven't tried a high deductible health plan and you're curious but you don't know how it'll work, you could try it 1 year. And if it didn't work for you, next year you can move out of it. And the other beauty of the HSA is that you own this account. It is yours, even if you switch out of that high deductible health plan. Very different than consumer driven health plans and FEHB, where you get a health reimbursement account and the plan owns it. And if you switch out, you forfeit any unused funds. So the HSA is always yours going forward.
Gotcha. So Kevin, you've set us up for kind of an awesome segue here. So for our federal families, especially those with kids or dependents or retirees, what plan features tend to matter most that people often overlook based on your experience?
Well, there's actually one I call it shaking the couch cushions. I mean, in this world where premiums are going up, there's something that I think is underutilized that many plans offer that I think are often overlooked. These are either supplemental benefits, sometimes they're called wellness benefits, sometimes they're called non-FEHB benefits. You can find these, a lot of times the carriers like to talk about these on their, websites, plan marketing materials, but also in the plan brochure at the end of section 5, they go over and they talk about discounts for dental, discounts for vision, hearing aid discounts. Maybe you've got a free gym membership. A lot of times they have like wellness incentive rewards. So if you go get your physical from your doctor and you take an online total health assessment, the plan will give you $100 in like a prepaid FSA card. And, I think in the world of like premiums increasing, out-of-pocket costs increasing in many plans, some of these I think are getting overlooked. And, I don't, they're not going to meaningfully change your life, but saving $100 here or $200 there can add up over time. And I think make sure you understand everything that your FEHB plan can provide you.
Yeah, it's true. We're not under FEHB, but even with our private sector plan, like there are benefits like that. I know that's a big trend in insurance these days to kind of offer those benefits. And it can be a little difficult. Like you'll get a mailer every so often, kind of randomly, and it's hard to keep track of with everything else that's going on in your life. But I think that's a really good point that you make, that there's probably some good rebates to be had and some good kind of offsetting to be done by taking a minute to dig a little deeper into those offers. Yeah, it's a good point.
Absolutely.
All right. Well, we've got, I know we're it's a little bit longer episode today, but we are coming
That's
to.
That's okay, though. We got Kevin Moss.
Yeah.
Absolutely.
Okay. One does not simply abbreviate when we have Kevin Moss.
Okay. All right, Dan. Lovely enthusiasm. I'm as excited as you are. Maybe we can talk a little bit about annuitants. And, I said that I felt like they have a little less moves to make. So the reason they have a fewer or less moves on savings is because once you're an annuitant, you're paid on annuity, you're no longer eligible for the FSA. And then if you enroll in the high deductible health plan, instead of getting the HSA, you get the HRA, which means that you can't contribute your own funds anymore. You basically lose the tax preferred benefits that are available to active employees. You're also paying your premium through your annuity. So you're also losing that tax benefit of paying your premium pre-tax and payroll. So you have less moves, but that doesn't mean you don't have moves. You have moves. Okay. So one thing that's happened over the last couple of years is greater integration of Medicare Part D, D as in drug. These are PDP or prescription drug plans that now many FEHB plans are offering. This is a potential savings for federal annuitants that have, medium to high prescription drug costs. Why is there savings there? There's savings because of how Medicare Part D has been reformed. So a few years back, we had the Inflation Reduction Act, which had major Part D reform. And it used to be a very complicated coverage scenario. And there, people probably have heard of the donut hole of like coverage. Well, there is no more donut hole in Part D. And it got all simplified last year, where every Part D plan had a $2,000 out-of-pocket limit. That's going up $100 next year to $2,100. But this means that for all covered drugs in your Medicare Part D plan, you will not pay more than $2,100 out of pocket. So if you have medium to high prescription drug costs, then this will be a way to save money. And in order to receive approval from OPM, these Part D plans have to offer equal or better coverage compared to the prescription drug coverage from your FEHB plan. This means they have to have access to the same drugs. And this is a huge point, especially in like 2025 going into 2026. And this is a key difference that FEHB has that the commercial Medicare market does not have. So there is a requirement in FEHB that every FEHB plan has to cover at least one GLP-1 weight loss medication prescribed specifically for weight loss. And because that requirement exists in FEHB, it also flows down to the Part D plan. It means that when you're on Part D, you still have access to that GLP-1 drug prescribed for weight loss. That does not happen in commercial Medicare right now. Right now, the only way that Medicare will pay for a GLP-1 drug is if you have an underlying condition like type 2 diabetes or heart disease. Then yes, you can get a GLP-1, but not prescribed for weight loss. Both Part D, you get that. And so not all FEHB plans have Part D, but some of the larger, more popular PPO plans, you will find it there. Plans offered by Blue Cross, for example, all the Blue Cross plans, the GHA plans, and there's several other plans. There's about 20 or so plans. But if you're not in one of those plans, you may want to consider one of those plans if you have medium to high prescription drug costs. Do keep in mind that there is no extra premium for that Part D coverage. However, if you're subject to what's called the income-related monthly adjustment amount based on your income, you might have to pay a Part D IRMA surcharge. Those income thresholds are going up next year. It's $109,000 for single filers and $218,000 for joint filers where IRMA thresholds start coming in. Okay, so Part D is one area. Now, the other area is if you are enrolled in Medicare Part B, B as in boy, and not everyone is, and IRMA plays a role into probably your decision about whether you took Medicare Part B. But if you have it and you haven't looked at Medicare Advantage plans offered by FEHB carriers, these are the lowest cost health plans that are available to annuitants. Now, they may not be the right fit for everyone, okay? Because, you will have probably a different provider network and there may be some different pre-authorization requirements in Medicare Advantage that are different than in your FEHB plan. But if we look at it just on the finances, these plans are thousands of dollars lower compared to other FEHB plan because they have two really important factors going for them. One, almost all of them have generous Part B premium reimbursement. So they're giving you back a lot of the Part B premium. United plans, if you live in a market with United Choice plans, you get $150 a month back on your Part B premium. And they have zero out-of-pocket healthcare costs. So doctor, hospital, emergency room, chiropractor, acupuncture, nothing out of pocket. If you see a provider that accepts the plan and Medicare, the only out of pocket you'll face is prescription drugs in these plans. But when we model these plans in our guide to health plans, you can save thousands of dollars. And I think everyone who has Part B should at least take a look and see what's out there, see if something may work out for you. Again, if we remember back to what we said earlier, you're only making a decision for 1 year. You're not making a decision for the rest of your life. And many of those Medicare Advantage plans also allow you to switch down to the FEHB plan outside of open season. So if you found yourself in a situation where the Medicare Advantage plan, denied care for something, you could go back into the FEHB plan, submit your care for approval, and maybe get a faster answer from your FEHB plan. So Medicare Advantage, if you have Part B, I think you have to do the homework. It may not be the right choice for everyone, but it is a possibility to save really a ton of money.
No, that's a great point, Kevin. And, once again, you're kind of leaning into where I was going. So, Kevin, you are one of the most important voices in the fourth quarter every year, but actually is it correct that people should be thinking about this well before October? So if they're thinking about a Medicare Advantage and there's one that's out there, they maybe should start seeing, does my doc accept this? Who are the docs that do accept this? And maybe start planning earlier in the year. Would that be a safe statement for you?
That would be a very safe statement, Dan. And you hit on one of the key factors in this, and it is access to providers. That's the thing that you really have to check here. And things can happen, and they can happen outside of open season. So if you were in one of those United plans and you live in the the Mid-Atlantic area around Washington, D.C., you got a letter from United that told you that there was a conflict with Johns Hopkins University, both facilities and providers, that they could not come to agreement for those providers to stay in network. So next year in United Healthcare, if they aren't able to get to an agreement, all of those providers are going to be out of network. So if you used Johns Hopkins primarily for all of your medical care, that could mean a lot more out-of-pocket costs potentially compared to if they stayed in network. So this is something that can change every single year. And yeah, I think that there's a little bit of homework that everyone can do, especially for things that you're not that comfortable or familiar with. So you can go onto STWS and get a lot of advice or listen to previous podcasts. I've, of course, written a lot of advice that's out there on a lot of the choices. And, all of us share the same mission of just trying to educate people about their choices, get them some things to think about, and just trying to give great advice for folks during open season and throughout the year.
Absolutely. So when people are looking for Kevin Moss in January of next year, where should they come to find you? Let's get that plug in there, buddy.
Sure. Our main website, guidetohealthplans.org, we have a special promo code for all listeners to save 20% on our Guide to Health Plans. It's STWS. So feel free to use that. We put all of our advice out there for free. So if you go to guidetohealthplans.org, you can read all my advice articles. I'm maybe not as advanced as you all are into like YouTube and podcasts, but I also have a little bit of a YouTube channel where I put some of my advice out. So you can see my YouTube videos there on guidetohealthplans.org.
Very
Absolutely.
Cool. We'll have to check those videos out. Yeah.
Oh, we're totally going to watch them.
Very fun.
As much as it hurts me to say this, that's all the time we have for today, because I could do another hour with Kevin. But folks, have no fear. We will be back next week, bringing the latest updates you need to know to make informed decisions about your career and financial well-being as a Fed.
Be sure, so that you don't miss that episode, to subscribe to our podcast on YouTube, on Spotify, and you can also find us on stwserve.com. so that you never miss an episode. And please, please, please remember to share it with your friends and colleagues. This is a great episode to share with any, Feds, either annuitants or Feds that are still, employed. As we head into open season, this can be, a little bit of a gateway for folks, maybe to galvanize them into action if they haven't reviewed their insurance plan in a while.
Absolutely. To paraphrase Bob Seger, here, there, and everywhere, it's hip to be share. So share, share, share. And for more information about the topics covered today and more, be sure to check out our blog. That's blog.stwserve.com, and subscribe to our newsletter, The Weekly Serving. That's where we push the stuff all the way out to you. You don't need to go looking for it into your inbox every single week.
And if you want to dive even deeper into today's topic, I would highly, highly recommend we have a webinar coming up. We've got our FEHB webinar coming up on November 19th. That's going to be from 10:30 a.m. to 2:30 p.m., and that is Eastern Standard Time. I know that's a big time commitment, but let's be honest. How much time and effort have you put into FEHB from January through October? Okay. So it might be time to play a little bit of catch up and learn something about your FEHB plan. So join us there. I believe, Dan, you are hosting that session.
Yes, I am.
Yep. So
and that's with expanded live Q&A. Expanded live Q&A. So that's why it's got the footprint it does.
Absolutely. So definitely join Dan there, get all of the information that you need to be well informed here this open season. Of course, if you don't have 4 hours to commit, or if you prefer a one-on-one approach, feel free to reach out to our team directly for a financial planning consultation at meetings@STWServe.
Absolutely. So I flashed the two because that's what we call part two. Everything else you've learned is part one. That's general education. If you want to know how it's going to affect you, that's part two. Hit us up for that. We'll help you wherever you got it. Wherever you got it, we'll be there for you. So thanks for listening to the Fed15. I'm Dan Sipe.
And I'm Katelyn Murray.
And the man in the middle is?
Kevin, you have to say who you are.
Hey, thanks, guys. Appreciate you having me today.
He's Kevin Moss. And Katelyn and I will see you next week. And be sure to go to Kevin's website, read his stuff. He's amazing. Take care.